Welcome to the COV-Course, a multidisciplinary approach to understanding the pandemic, coming to you from the University of Illinois at Urbana-Champaign. My name is Gene Robinson, and I'm the Interim Dean of the College of Liberal Arts and Sciences and the Director of the Carl R. Woese Institute for Genomic Biology, two of the units on campus which have contributed to the design of the course. It's my pleasure to introduce this Sunday evening session, and with it, some of the thinking behind the experience we have created for you. The COVID-19 pandemic has created an unprecedented public health crisis of proportions so huge that you can really only grasp them by taking a 360-degree view of what's happening. At Illinois, this kind of kaleidoscope approach is our signature. Over the course of the semester, you're getting a chance to gain a comprehensive, multidisciplinary understanding of the pandemic. The course has been guiding you through the past, present, and future perspectives on what's happening now with weekly topics that range from history, biology, business, to data security, racial disparities, mental health, and more. Our speakers and moderators, world-class scientists, humanists, social scientists, artists, and community partners, have been sharing their knowledge and insight on many of the factors and conditions we're reading about, but want to know more deeply about. Individually and together, their presentations have been showcasing how interdisciplinary research and expertise can offer unique perspectives on this global health crisis and its consequences. Here at Illinois, we operate on the assumption that the best way to stay safe is to learn more about the pandemic in its many dimensions, and then to be able to come together as a community at this time of crisis and uncertainty. This program was built with support from the Office of the Provost, the Carl R. Woese Institute for Genomic Biology, the Center for Social and Behavioral Science, Humanities Research Institute, the Interdisciplinary Health Sciences Institute, the Siebel Center for Design, the College of Liberal Arts and Sciences, and the Granger College of Engineering. I speak for all of my colleagues in those units when I say we're delighted to see you and to be able to bring such distinguished speakers to the table for you. Before I introduce this evening's guests, and because we're broadcasting from Urbana-Champaign, we would like to acknowledge that we are on the lands of the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Odawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasaw nations. These lands are the traditional territory of these native nations prior to their forced removal. These lands continue to carry the stories of these nations and their struggles for survival and identity. As a land-grant institution, the University of Illinois has a particular responsibility to acknowledge the peoples of these lands, as well as the histories of dispossession that have allowed for the growth of this institution for the past 150 years. We are also obligated to reflect on and actively address these histories and the role that this university has played in shaping them. This acknowledgement and the centering of Native peoples is a start as we move forward for the next 150 years. And now let me introduce our speakers for this evening. Our first speaker is Professor Heitor Almeida. He's the Stanley C. and Joan G. Golder Chair in Corporate Finance and Academic Director of iDegrees at the Gies College of Business. He joined the University of Illinois in 2007 and also works as a research associate for the National Bureau of Economic Research. His research focuses on corporate finance issues such as liquidity management and share repurchases. He serves or has served as associate editor for numerous academic journals and is currently in that role for the Journal of Financial Intermediation, the Journal of Banking and Finance, and the Journal of Corporate Finance. His work has been featured in several media outlets such as the Wall Street Journal, Financial Times, New York Times, and USA Today. He has a Master in Economics from Pontifical Catholic University of Rio de Janeiro in Brazil, and a PhD in Economics from the University of Chicago. After Professor Almeida speaks, our next speaker and moderator will be Professor Robert Lawless. Robert Lawless is the Max L. Rowe Professor of Law and co-director of the program on law, behavior, and social science at the College of Law, where he writes and teaches about bankruptcy, consumer finance, and business law. Professor Lawless has testified before Congress several times about bankruptcy and household finance, and his work has been featured in national media outlets such as CNN, C-SPAN, NPR, the New York Times, the Wall Street Journal, and USA Today. Born and raised in Illinois, Professor Lawless received both his degrees in accounting and law from the University of Illinois. This session will examine the financial consequences of the COVID-19 pandemic for the US economy. It will discuss the differences between the COVID-19 crisis and the 2008-2009 financial crisis and explain how US companies and the US government responded to the crisis. This session will also examine medium and long-term implications of the COVID-19 shock for the US corporate sector in light of the progression of the pandemic and the potential rollout of fresh government intervention. We're delighted to have you both here. Thank you very much. And Professor Almeida, if you'll get things going.
Thank you, Gene, for the introduction. Welcome everybody to this Sunday evening talk. It's a pleasure to be able to give this talk to you and have this discussion with Bob about some of the issues of, as Gene said, the talk today is about the financial consequences of the COVID-19 pandemic. My expertise is in corporate finance, as Gene said, so it is for us in corporate finance, it's a very interesting, these are very interesting times because the COVID-19 crisis from the financial point of view is fairly different from the previous financial crisis that we experienced, which is the 2007, 2009 financial crisis. That one hit mostly households and banks, right? So it's a crisis that started in the mortgage market, and then it affected heavily the financial sector of the U.S. Some banks went bankrupt, as we know now. The COVID-19 crisis is different because it's a direct shock on non-financial profits. So in the previous financial crisis, banks were heavily affected, but companies were only indirectly affected by the crisis. And then as it turned out, there really wasn't a major negative shock in the corporate sector, but it's very different this time because COVID-19 is a direct shock to profits, as we're going to talk about today. And because of this, COVID-19 elicited different responses from both companies and the government. And understanding these responses for me is particularly interesting, as I said, because it's right in my field, and it's been very interesting. Of course, this is crisis is horrible, as Gene explained. The public health side is really bad, but on the other hand, there are some interesting. And I think in the end of the day, I think I'm going to have a positive message about the financial sector and the corporate sector. So this might be more positive than what people might expect. So this is the summary. I'm going to talk about this liquidity crisis that I mentioned, and then talk about how companies and the government responded to the shock, to the COVID-19 shock, and then talk about challenges going forward, and discuss whether there is the need for more government intervention or not. So in terms of the shock, the major effect of COVID-19 on the corporate sector is this decrease in profits. So this is what's in this picture here. It's a very interesting picture from Standard & Poor's that shows you profit forecasts for the large U.S. companies, those that are in the S&P 500. So, and these are rolling forecasts. They are taken in different periods of time. And I think they show the magnitude of the shock very clearly. If you focus here at the end, there is this blue line that's the profit forecast as of February of this year. So everybody expected earnings to continue to increase. And then what happened is that once COVID-19 hit in March and April, there is this very significant drop in profits that you can see here. This is what they are calling the earnings recession. There is this very significant drop in corporate profits in 2020. And then the other thing that this chart shows is that there is the market expects profits to go back up in 2021. So there is this large negative shock to profits in 2020, but as of today, the recovering profit growth is expected in 2021. So what should companies do in this scenario where you have this negative shock to profits? Rather, I'm going to show you some data for the US economy as a whole, but I actually want to use an example to explain what happened in the corporate in the corporate side. So let's take a company that was definitely heavily affected by the crisis. It's a Roof's Hospitality Group, which is the owner of Roof's Chris Steakhouse. As you probably know, their business is indoor dining, right? High-end indoor dining, and that's exactly, it's a great example of a company that got affected by the crisis. So for Roof's, they had profits of $75 million in 2019, and once the shock hits, the profits drop significantly, right? So as you can see here, the profits are expected to be $9 million in 2020. So the profits dropped almost to zero, right? And then the expectation is that profits are going to pick up, right? So very consistent with the overall picture. What analysts expect now is a very bad 2020 and then profit growth in the future, right? What should companies do in this case, right? The problem for a company like Roofs and for the US corporate sector as a whole is that this shock creates a liquidity problem. There is a potential liquidity problem because companies have bills to pay. So in the case of Roofs, for example, we can get data and then we can measure that for 2020, Roofs had short-term liabilities of about $60 million. Including accounts payable, financial payments that they had to make, etc. So they had to come up with $60 million, right, to stay afloat. They only had $5 million in cash at the beginning of 2020, so Roofs needs to raise cash. Okay, so they have to go to financial markets and bring money, issue more finance, bring more money in the company. And one important point that we know from research, but it's pretty obvious, I think, and intuitive, is that short-term financing doesn't help, right? So issuing a bank loan that is due in 2020 is not going to solve the liquidity problem because you're going to have to repay this loan during the COVID-19 crisis. So what companies try to do in this case is to go for long-term finance. And US companies and companies around the world have two major sources of finance. The first is debt, right? Borrowing money, or they can issue equity, like sell shares in the market, bringing more capital from the markets. What we know from research as well is that US companies do not like to issue equity. And that is especially the case when stock prices are low. So when the first wave of the financial crisis hit, stock prices decreased. Roof's stock price, for example, decreased almost 50%. And in this case, companies are unwilling to issue equity because it's costly, right? So what they try to do is US companies went for long-term debt. So what US companies like Roofs try to do in this case is to borrow money that they only need to repay in the long term. And there are basically two sources of financing that US companies have in the debt market. One is bank loans, right? Borrowing money from a bank. The second source of debt financing is to issue bonds, right? What we call bonds. You can think of bonds as a piece of paper that it's essentially a promise to repay investors. And then what happens is these bonds start trading in the market. They become securities that investors can buy and sell. Okay. That's exactly what Roofs did. Roofs decided to issue long-term debt. When you look at the data, right in March 2020, when the lockdown started, Roofs issued $85 million in new debt. And then what did they do? They held the proceeds as cash balances. So companies went to the market to issue long-term debt to boost their liquidity. So the cash holdings of Roof's Chris went up from $5 million to $71 million in March. Okay, so here is a sketch of the idea of what happened in the corporate sector. Companies have this temporary shock to profits, right? There's low cash flows today. What they did is they borrowed money, long term, right? And then held cash, so increased liquidity. The idea, of course, is in the long term, when it's 2021, 22, etc., profits are going to go back up, and then U.S. companies are not going to have problem repaying debt. Okay. In the meantime, Rowe can use this cash to pay bills, right, and to support the business while the COVID-19 crisis lasts. So that's what U.S. companies did. And here, one key issue, though, that's going to be a major focus of my talk is that it's not trivial to raise financing in the middle of a crisis. That's true for equity because stock prices are low, companies try not to issue equity, but it's also true for long-term debt. In fact, what we know from the data is that debt markets were virtually shut down in the beginning of March 2020. So companies wanted liquidity, but everybody wanted liquidity. Banks wanted liquidity, investors want liquidity. What happens then is the market shuts down, and this graph kind of shows that it's a graph that it's basically the prices of loans. So these are bank loans that trade in the market. What this graph shows is that right in the beginning of March, the implied interest rate, so these are prices, there's a little bit of finance theory here, but I'll just explain in simple words. The implied interest rate on these bank loans in the beginning of March was about 4%, 3.8%. Once the crisis hit, in a few weeks, the interest rate on these bank loans, the implied rate fell to 11, increased to 11%. So interest rates shot up through the roof. And we also know that even at those high interest rates, it was fairly difficult for companies to borrow money. So the debt markets were virtually shut down. Okay. So how do companies raise financing when debt markets don't work? So on the corporate finance side, what happened is that U.S. companies relied on credit lines. So bank credit lines was a major source of financing for the U.S. sector during 2020. The advantage of a bank credit line is that the loan terms are predetermined. So when a bank borrows money from an existing credit line, you can think of a situation in which your interest rate is already set. It was already set in the past when the firm contracted the credit line with the bank. And then the credit line also specifies the maximum drawdowns, the maximum amount that the company can draw. That's exactly what Rowe's did. So Rowe's response to the crisis was to draw down on its credit line. So here's an excerpt from the company's annual report. Exactly on March 16th, right when the lockdown started, the company drew down on the remaining amount that it had on its credit line. It was $51 million. And then it used that money to increase liquidity, as we showed. Notice the interest rate. This is a time at which interest rates in the market were 11%. The interest rate on the loan that Rowe got at that point was only 2.74%. So this is the role of credit lines. Credit lines provide companies with liquidity insurance. This is an idea that we have shown in the past in the corporate finance research, including some papers that I have written myself. And this is what happened during the crisis. Companies used the insurance, right? The house was burning down. It's time to call the insurance company. Of course, insurance has a price, right? So the way that the markets work is companies pay a commitment fee. So, for example, if Rowe has $100 million credit line, it will pay between 0.25 to 0.75% a year on the total drawdown limit. So if you have $100 million on a credit line, you're paying the bank a fee every year to maintain this credit line. So you can think of a credit line as a mix. It's a mix between a corporate credit card, right? This is a little bit like a credit card, but it's a credit card that has insurance. Credit card interest rates, as we know, are very high. It's not true for credit line. So there is some research already showing that what happened during 2020 is that U.S. companies massively drew on their credit line. So this is a chart from a paper showing that there were $300 billion of drawdowns between March and April, right? So $300 billion is a lot of money, right? That U.S. companies drew down from the credit lines. And then there is this other graph here that you can look at on your own later. You can check the names of the companies. So that the usual suspects are here. Companies that got hit with COVID, hotels, cruises, GM and Ford are here as well, and other airlines. So these are companies that were hit heavily with this shock. Okay, so credit lines helped, but the problem is not all companies had access to sufficient pre-committed financing, right? So what if you don't have a credit line? Okay, that's where the U.S. government came in. Okay, the U.S. government understood that at that point it was essential to provide liquidity to debt markets. Companies needed long-term debt. The debt markets were closed, right? The companies relied on credit lines, but there is a limit, right, to this option. So essentially, the U.S. government stepped in to provide liquidity to debt markets. As we know from many decades of government intervention, the government is typically the lender of last resort. So when all lights go out, right, the only lantern remaining is the government, and that's what happened again in this crisis. The U.S. government designed, the Federal Reserve together with the Treasury designed several policies that aim at providing liquidity to debt markets. I'm not going to talk about all the details here. There are slides that you can read on your own. There are also some references that you can read. So there is a facility called the Corporate Credit Facility that is essentially supporting the bond market, right? So companies issue debt by issuing bonds or borrowing money from banks. So the U.S. government had different facilities for different types of debt. There is the Corporate Credit Facility, which targets the bond market. So essentially, the U.S. government can take money from taxpayers and use that money to buy bonds and support the bond market. And then there is the Main Street Lending Facility, which targets companies that borrow from banks. So some companies borrow from banks. The U.S. government created a liquidity provision support facility to support the bank lending as well. Okay, and then of course there is the Paycheck Protection Program, the PPP, which targets small companies. The difference is the PPP is not those are not really loans, right? The PPP is essentially a grant, right? So the U.S. government is not expecting to get paid, as you probably heard in the press. Those are forgivable loans that are given under some conditions. There are restrictions on usage. Essentially, the idea is to allow companies to keep employees on payroll. So the companies have to keep employees on payroll in order to access the PPP, right? So did it work? The answer is largely yes. The U.S. government was successful in restoring liquidity to debt markets. There are lots of evidence that this is the case. For example, bond issuance in 2020 was at a record level. I'm highlighting here the amount of debt that U.S. companies issued in the bond market in the first months of 2020 is unprecedented. If you look at the previous years, it's a much larger amount. Okay, prices also went down. So this is the same chart I showed you later, but now you can see that there is a line here that indicates the exact date at which the Fed announced the corporate bond buying program. And what happened is immediately interest rates started going down. So the prices of these loans went up. And what the companies did is they took advantage of these programs to increase liquidity. So companies issued debt to increase liquidity. So this chart is showing that cash holdings in U.S. companies went up. Okay, so that's the story. It's a short story. It's in 15 minutes, right? That's the story of 2020 in the U.S. corporate sector. So with the help of the U.S. government, that was crucial, and also committed credit lines, the U.S. corporate sector responded to COVID-19 by issuing long-term debt to increase cash holding. Okay, so this is very clear, I think. This is really what happened during 2020. What about the future, though, right? So where we are right now, what's going to happen in the future? That's what I want to do in the last 10 minutes that I have, is just to share some thoughts about what's likely to happen going forward. The concern that many financial economists and economists in general had this year is that liquidity is not enough. So what companies did, as we explained before, is to increase liquidity, but this strategy relies on the assumption that profits are going to go back up in the future, right? What if that doesn't happen? What if high cash flows never come? What if the pandemic lasts longer than we expect, right? And roofs, Chris, for example, might not be profitable for a few years. Then we're going to have problems, especially because, as we just showed, COVID-19 generated a significant increase in corporate leverage. Companies responded to the crisis by issuing debt, right? So there's more borrowings that they have to repay, profits are down, financial crisis, right? So lots of economists were concerned about a second wave, a second financial crisis. If the pandemic moves into 2001 and later, to 2021 and later, the corporate sector might be in trouble because this temporary shock to profits turns into a persistent shock, right? So this debt is going to start coming due, profits are low, we're going to have a financial crisis in Main Street, okay? In fact, I had a talk earlier. I gave a talk earlier in the summer here for students and alums at the business school, where that was the title: "Is there going to be a financial crisis in Main Street?" And fortunately, I think right now I would venture out to say that the answer is no. So, and the reason why I'm saying that is, it's basically on using what financial markets are telling us about the future. We can look at stock prices, we can look at the bond market, right? If there is really a concern with a financial crisis, then what we should see interest rates going up again, right? What's happening? So rather than focusing on stocks, which you're probably more familiar, that's what the financial press follows, etc., I'm going to show you some data on the bond market. Okay, so there are several charts here you can look at on your own. I'm going to focus on the riskiest bonds, which we call the high yield. HY here stands for high yield. And you can think of these as the riskiest companies that borrow in the bond market. So they have a lot of leverage, so they pay high interest rates, right? And this graph is telling you the history of COVID-19 in the bond market. In the beginning of March, as we saw, there is this huge increase in interest rates, right? So the bond market closed down. Once the government intervened, it started coming down. And the striking feature of this chart is that if you look at the level, spread. So what this graph is showing you is a spread. It's the difference in interest rate between a high yield bond and a treasury bond. The spreads are at 4% now, which is the historical level. So essentially, the bond market is back to normal. The crisis is over, right? That's what bond markets are telling us. It's not just the stock market. The same thing if you look at loan prices, by the way, the same chart I showed you, the prices of highly leveraged loans are back to normal, okay? So there's major, and this is the good news I wanted to share with you. There's major improvements, I think, in the economy since March. In particular, when we look at credit risk, interest rates, the bond market, etc., it has moved back to normal levels. And what we know, we also know, you probably saw in the news, right? The stock market is at historical high, right? So the financial markets are telling us that the crisis is over, and I think it's probably the case that we're not going to have a financial crisis in Main Street. It would be, of course, this is a forecast, right? Things could change, but at least it looks much less likely that we're going to have a crisis now than in the summer of 2020. And I think part of this has to do with expectations I'm going to talk about in a second, but I think we have to say that it's also because of what happened during 2020, right? The government intervention in that market was successful. Companies were able to raise funds and to increase liquidity. So it's this combination of successful government intervention and clever liquidity management that helped avoid this financial crisis in Main Street, okay? Things could still go wrong. There are some very famous investors like Bill Ackman, for example, that this is an article from the Financial Times. As you can read here, Ackman believes that the markets are once again complacent about the impact of the pandemic. So Ackman made a lot of money in March when the pandemic first hit. He was one of the people who was betting that we were too complacent and maybe it will happen again. So, I mean, this could be the case. There are people that disagree, right? And I think it's quite striking when you think of this, because as we know, we are in the middle of a second wave, right? So the second wave of the virus looks just as bad as the first wave in March and April, right? And what some economists are worrying now is whether we may still have a second wave of the financial crisis, right? And markets are telling us the answer is no. But this is the question, I think, going forward, and that's what I want to talk in the last minutes here. So in terms of public health, this is a graph that shows daily deaths in the US. The second wave that we are in now, it looks just as bad as the first one, right? So, and you can look at infections as well, but basically we are in the middle of a second wave. So wave 1 and wave 2 look similar on the public health side, but there is no second wave of the financial crisis, right? So our market is really crazy, like Bill Ackman thinks. You know, it's not necessarily the case once you think about what drives market prices, right? So stock prices and bond prices and loan prices, interest rates depend on the future. So what markets expect now is that as bad as the crisis is now in 2020, we're going to have a horrible fall in winter probably, but the crisis will be over soon, right? Because there's very good news about vaccines. There is an expectation that this crisis at some point in 2021, we're going to start getting back to normal. And this is clearly what markets expect when you look at prices, when you look at profit forecasts. So there is this expectation that may be a bit optimistic, but I think it's reasonable given the what we know now about the pandemic. Stock prices and bond prices also depend on uncertainties, what we call the risk premium. And I think we know a lot more about the virus now than we did in March 2020. March 2020 was a time of huge uncertainty, right? I mean, we didn't know if the virus transmitted in surfaces or who was really susceptible, you know, how bad the situation was going to get. Was there going to get, you know, there were lots of uncertainty, and that contributed to that financial crisis, the first wave of the financial crisis that the US government managed to tackle together with the corporate sector. Okay, of course, things could still go wrong, and Bob is going to talk to you about a little bit about the personal side. I think household finances might not be as rosy as the corporate sector, if you want. Of course, if there is bad news about vaccines, right? Either the effectiveness or difficulties in distributing vaccines, you know, it's not my expertise, but for sure, if you know, any bad news about vaccines are going to directly affect the market and could trigger this problem that we talked about, right? Prices going down, companies have to repay debt, profits don't come, and then, but hopefully not. Okay, and the last thoughts I want to share here is that even in the corporate sector, there are heterogeneous effects. So the economy as a whole seems to be doing fine. Unemployment is down. The markets, you know, markets are doing fine. But there are some firms and industries that were hit very hard and still are. So, for example, we know that COVID-19 has been worse for small business, right? The stock market is not really a summary statistic of the US economy. You know, the stock market is driven mostly by large companies, right? So just by the nature of it. And we know that small businesses were hit harder. For example, there is this very interesting article recently in the Wall Street Journal talking about the fact that COVID is crushing small business. For example, there is this striking statistic showing that 42% of small businesses are at the risk of going out of business by Q4. So this was about a month ago, but I think it does capture this. And of course, some industries are still suffering, right? So entertainment, travel, you know, restaurants, right? So this is a graph that shows you the increase in bankruptcies in these heavily hit industries. So the point is that there is heterogeneity, right? And the last thoughts here is, you know, should we care, right? What should the US government do to extend support? You know, should we extend support to small firms and heavily hit industries? And here there is a debate. I don't think there is a consensus among economists about what should the US government do next. You know, it seems obvious we have to support small firms, right? And some industries like airlines are essential for the economy. But on the other hand, there are or some economists that at this point believe that it may be counterproductive to keep supporting the corporate sector. It might be better to, as this title says here, to support workers rather than support jobs. One of the arguments is that corporate failures or bankruptcies, which is Bob's specialty, by the way, as Gene was talking about in the beginning, are not necessarily that bad for society, right? You know, we're going to be very sad, for example, if our local restaurants go bankrupt. But once the crisis is over, and once demand is back, you know, restaurants will rise again, and maybe different owners, but the jobs will be there. So it's not clear that corporate bankruptcy really has a major welfare effect for society. And then there is the other argument is that indefinite government support can create problems. It can hurt. It can end up hurting business by supporting firms that maybe should go bankrupt and assets that should be reallocated. So there is, for example, this article that I cite in my reading list by Raghu Rajan, making this point that maybe it's over, right? I mean, we shouldn't keep supporting the corporate sector. We should focus our support on households at this point. So, like I said, you know, I'm out of time here. I have this reading list that you can have a look. And if anybody has questions, you want to you know, ask questions about this, discuss any of these issues, you have access to the slides, you have access to the readings, and I'm available by email. I'll be happy to talk to you about that. So thank you. I'm going to pass the ball to Bob.
Yeah, so thank you. So and thank you so much for inviting me to do this. It's truly an honor and a privilege. And I appreciated the introduction. I appreciated the thought about interdisciplinarity, because I think this talk illustrates the advantages of that quite well. So Heitor spent a lot of time talking about the corporate sector. I spend a lot of time thinking about the household sector. And you know, there's no question that what is best for the well-being of the household sector is what's best for the overall economy. If the economy does well, then households are going to do well. But we also know that this is a large and diverse country. We know that economic gains do not fall evenly across American households. And even for the households that are going to see economic gains, or at least economic recovery from this pandemic, it'll take time for that recovery to get to those households. And in the meantime, there's going to be economic pain for those households. And what that means is foregoing educations, foregoing starting a family, foregoing buying a home, in short, foregoing opportunities. That's at best. At worst, the economic pain, the failure to recover, will mean struggling to get food, struggling to put a roof over your head. And at this point, and I think we can go ahead and share again the PowerPoint, you know, there's a fair number of studies where the financial problems from the COVID pandemic and where they're going to fall. And what they all show is that the effects are not spread evenly across society, and that they fall most heavily on racial minorities and the financially disadvantaged. And so as I said, there's a lot of studies. So I just, for purpose of this talk, went out and found a few that I thought were particularly illustrative. So here's a report from the Congressional Research Service, and all of these studies, there's a lot more to them, but I kind of grabbed a table or a key finding from each of them. And here from the Congressional Research Service, showing that job losses are concentrated among the lowest wage earners and somewhat more prevalent for people with minor children. So the people who are already the most financially vulnerable are being hit the hardest in terms of job loss and losing income. And then on the next slide, we got a report from the Pew Research Center showing 46% of people who've lost a job have dipped into savings. 38% of people who've lost a job have had trouble paying bills. 27% have had trouble paying a rent or mortgage. So again, right, the recovery is going to take a while to trickle down to households. In the meantime, trouble keeping a roof over your head, putting food on the table. A study from 2 labor economists on the next slide, including one from Professor Eliza Forsyth, who's at our own College of Labor and Employment Relations. So this study found that Hispanics, younger workers, and those with lower levels of education, as well as women, had more job losses. And one explanation perhaps is that, well, those groups tend to be employed in industries that were especially hard hit like retail or food and beverage or industry, but that could only explain part of the difference, even after controlling for where these people worked, what industries they worked in, these effects remain. So again, right, the problems from the crisis are not being evenly distributed across society, and it's not just a matter of where people work. And if you've been following the news, none of that might be surprising. It's important to remember that as we rebound from COVID, not everyone's going to come along for the economic ride. In many countries, there's a robust social safety net that provides minimum housing, food, medical security. And we have some of those things, of course, in the United States, but not as robust as many other countries. And for decades now, we've been leaning particularly on a part of the social safety net that's my specialty, and that is the bankruptcy system. And many people don't realize, on the next slide, many people don't realize, I think, just how much we've leaned on the bankruptcy system. So just take a moment. If you're watching this, think for yourself, okay, so what is the best estimate of the number of Americans who file bankruptcy at some point in their lives? Right, so you got a lot of options there, and then the answer is on the next slide. Yes, it's 1 in 10. So this is based upon some kind of back of the envelope math about what we know about when people file bankruptcy, how old they are, how long average life expectancy is, how many people file, et cetera. 1 in 10 Americans walking around have filed bankruptcy at some point in their life. That's about the best number. It's probably a little bit of a conservative estimate, to be honest with you. And I wanted to spend a few minutes talking about this. I wanted to give some sense of how much we use the bankruptcy system as a social safety net, because something odd has happened that we don't really fully understand. And on the next slide, we show that bankruptcy filings have fallen off a cliff. So this comes from US courts that report the number of bankruptcy filings each month. And so you see there, January, February, right? There's actually numbers there. You can't really, was no change from 2020 to what had happened a year prior. And then in March, as the pandemic hit, bankruptcies, and these are consumer bankruptcies, just started declining. And then by April, when the pandemic was in full swing, bankruptcies were down over 40%. And since then, it's been pretty consistent. They're down about 38 to 40% consistently since then. It was like flipping a switch, right? That all of a sudden people stopped filing bankruptcy. Contrary to some beliefs, the bankruptcy courts remained open. Most bankruptcy filings are done electronically anyway, so bankruptcy filings continued even during the worst of the pandemic and the early stages of the pandemic. The bankruptcy courts remained open, and it was like flipping a switch. And so I say, no, we can't really understand what happened here. It's not likely that people all of a sudden had less of a need for bankruptcy. There would have been people in the absence of the pandemic. If you can imagine a world where the pandemic happened, there would have been people who would have filed in March, April, May, et cetera. One thing we know about bankruptcy is for households is it has a long buildup. So, people who arrive in bankruptcy court have usually been working their way there for a couple years in terms of financial distress. They've struggled for a while. All of a sudden in April, those people stop filing bankruptcy. The next slide shows that this has not been uniform across the country. So the biggest decline, so the areas here are federal judicial districts. Some states have only one judicial district. Here in Illinois, we have 3 federal judicial districts. And the darker the color, the bigger the decline. And so we haven't, we see here that it's not uniform across the country. I don't think that the decline in bankruptcy filings is some indication that things are going well. But it, I think, points to some larger problems with access to aid, access to the sort of things that are going to help. I think, again, no one's really sure what's going on here. I think, my best guess is that there's 2 things going on. Is first, lawyers have been less able to market bankruptcy, especially Chapter 13 bankruptcies, which are predominant in the US South. So you see a lot of the biggest declines, the darker reds, are in the US South, and I think that's a reflection of that. There's also been robust debt collection and eviction moratoria in some states like Illinois, New York, Massachusetts. I think that's eliminated a little bit of the need for people to file bankruptcy, but at the same time, it's not a complete explanation, because all of a sudden, again, in April and May, there was still, those moratoria hadn't really had their effects yet people had stopped showing up to bankruptcy offices, to bankruptcy lawyers' offices. So, I wanted to talk a little bit and just add a little bit, my role here is the moderator, to add a little bit of kind of an additional interdisciplinary perspective to Heitor's specialty in corporate finance, and talk a little bit about what's happening at the household sector, talk a little bit about the bankruptcy system. The big question for the bankruptcy system is whether we're going to see a wave of bankruptcy filings in the future. I kind of say it's not going to be like a wave, it's going to be like the tide coming in. My best guess is it's going to be a gentle just run up, and in a few years we're going to see more bankruptcy filings, because again, as I said, what we see historically is that the seeds of bankruptcies that are filed today were sowed 2 or more years earlier. So, with that and just kind of adding that additional perspective, I guess those were all the slides that I had, and I wanted to come back, having talked a little bit about here some of the household problems, Heitor, I wanted to come back. I mean, I think, well, so first, I guess the question I had, I'd written, I think we both agree there need to be more stimulus, but I guess I'm not so sure after listening to your talk whether you think there needs to be more stimulus. I do. I don't know what you think. Do you think there needs to be more stimulus?
Well, I think that the next wave of stimulus has to focus specifically on sectors and people who are suffering more with the crisis. So the difference is the first wave is a general support, right, of debt markets, to the entire corporate sector, really. And then there is the stimulus checks, etc., right? So I think going forward, the government needs to be able to, if there is going to be any stimulus, right, I think you have to identify, as you said, I mean, which people are suffering more, which sector, which part of the corporate sector really needs stimulus before you even consider doing something. I think like the idea of extending over general stimulus for the corporate sector is probably not a good idea. So I think it needs to be targeted, and then really, we need to think carefully about whether we, what we want to do going forward. I think based on your talk, it seems clear that we probably still want to keep supporting people, right? It was the title of the last slide, support workers, not jobs, right? So that maybe going in that direction going forward and moving out of the corporate sector a bit, maybe might be a good idea for 21.
Well, do you think so? So of course, household spending, consumer spending is a big part of the economy. Is the possibility that that households are going to continue to have issues, they're going to pull back on spending, that's going to snowball, right, as people spend less, some of this recovery might start going away. Do you think that's a risk?
Yeah, of course, I think it's a big risk. That might be another reason why you want to focus support on consumers, right? If the idea is to support demand rather than liquidity, right, then I think what you need to do is support people. What markets are telling us is that it shouldn't really be difficult for companies to raise financing now. So that's not the problem is not raising funds, right? The challenge, as you said, may be to make sure that there will be a demand recovery. But then what that suggests is that we might want to, extend the stimulus checks rather than worrying too much about the corporate sector, right? So, focus on workers, not jobs, might be kind of a lemma, right? I mean, a big sort of a catchphrase, right, for the next round of stimulus, I think. And yeah, but there is this risk, right? And then there are political risks, right, that we can think about. I mean, we were talking about this before before we started, right? The U.S. government actually decided that they will probably stop these policies that we discussed today, the bond, to support the bond market, etc., are probably going to be phased out, right? And then the question is what comes next, right? And there is the risk that this is being done for political reasons, right, rather than really for with a good economic reasoning, right? So it's more about politics and the government transition, etc., rather than really thinking about what's best for the economy. So
we can put that on your list of other risks, right?
yeah.
Right?
Political risk.
There's a lot of concern about this, right? Is whether, I mean, how should we say it delicately? Maybe the government or the Congress doesn't always act in the public interest, right?
No. I think it's safe to say that. Yeah.
Yeah, that might be quite safe to say, at least in my opinion. You and I talk. I mean, you can always throw money at the problem, and I think there, at least again, in my opinion, I think I should say that pejoratively, like throwing money is bad. I think that this is a time we do need to support households and support workers. Money always helps, though, right? And one of the things I like to also emphasize is there's other non-monetary things maybe the government could be doing, right? And so, I looked, so not to keep harping on the bankruptcy system, it's a part of the social safety net. Again, I think people underestimate how often it's used, but there's big barriers to entry there right now. There's, just problems dealing with the technicalities of the law around how lawyers get paid for consumer bankruptcy. I torture my students with these technicalities. We don't need to go into them, but, they're technicalities, and, that could get fixed. Right, and make it easier for people to be able to go see a bankruptcy lawyer. There's been various moratoria too on debt collection. So Illinois has very robust right now moratoria in place on debt collections and evictions, both for foreclosures or whether you're renting. Not all states have been doing that. Right, the federal government ordered a eviction moratoria through the CDC. That's going to expire in the end of December. We'll see whether the CDC continues that, but that doesn't reach everyone. And at the end of the day, that also just kind of kicks the can down the road, right? The moratoria don't erase the rental, what you owe your landlord for rent, or the debt collection moratoria doesn't erase the debt. It just kicks the can. It just kicks the can down the road.
So I mean, this actually brings me to a question I wanted to ask you, right? So in your view, I know it's a tough question, but in your view, what would be the most effective type of stimulus for the household sector at this point, or going forward in 21? What do you think the government should be doing now?
Well, I mean, I agree with you. I mean, I think there needs to be targeted payments to American workers and American households. I think, again, without doubt, that needs to be done. I think there need to be extensions of some of these protections. Again, the moratoria. But again, at the end of the day, those are going to end at some point, right? You can't just say, you never ever have to pay your rent ever again.
Yes.
That won't work. So I was thinking about, there need to probably be more targeted kind of opportunities for individuals to restructure debt, right? In the corporate sector, you talk about restructuring debt, the corporation can't pay. There's all sorts of mechanisms, workouts that happen, and those aren't as available for individuals. Bankruptcy is available. It's kind of a blunt tool. It would be great, I think, if we saw either probably at the federal level, but could be at the state level, more tools for homeowners to try to deal with the troubled mortgage. I think Ireland has just put into place. I just saw so a webinar I'm going to make sure I get to as a webinar about a new Irish initiative to allow kind of a very targeted legal proceeding if you're having trouble with your home mortgage to deal with that. And so, you're not in kind of a full-blown debt relief procedure. You're just dealing with the home mortgage. But, it could go farther than that, right? I mean, not everyone's a homeowner. People need have cars, and, they're behind on car payments, right? But right now we've just kind of got a one-shot debt relief system. You go into bankruptcy, it's everything. But I think we need some more, especially in this time, some more targeted legal proceedings that will allow people to deal with the debt problems that they're having rather than kind of a one-size-fits-all.
Yeah, and going back to an issue you discussed, it's probably even more challenging for poor households, right? And to have good access to the bankruptcy system, then there is some inequality there as well, I bet, right?
Yeah. Yeah, I mean, I don't know if you feel so like an average, now I'm getting into some, so, the average Chapter 7 bankruptcy, which is a liquidation, you're going to pay an attorney, at least from our numbers, from our research, $1,200 is the average fee, right? And that's a lot of, and you have to, because this goes back to the way you have to pay, because of the way bankruptcy law works, you have to come up with that money in advance. And that's a lot for people to if you're having debt trouble. And we already know, right? You go out, you ask the average person, could you raise $400 if you had a problem? And a good percentage of people say no. And now you're asking people to come up with $1,200 or even more for what's called a Chapter 13 bankruptcy. Those bankruptcies are $3,500 on average, just for the attorney fee. Yep. So those are the sorts of things I think the government could be doing. We could be Congress, and I think there is some interest in Congress in trying to take some steps along those sorts of lines to try to do some targeted changes in the law that will help people access programs that will deal with particular issues.
Yeah, and these changes may have long-term benefits, right? It's not just a COVID thing. If you can make the bankruptcy court more accessible for poor households, I mean, this would be a major plus for the economy, even in the long run, right? It's going to go way beyond, right, the crisis we're in.
Yeah, I think that's right. And it doesn't have to be, again, it doesn't have to be like full-blown bankruptcy. You could imagine you'd have like, quote, mortgage bankruptcy, where the only thing you're dealing with is your mortgage. But maybe one more question I want to throw back to you, because you're talking about households, and I think just one last question, then we'll let Jean come back and wrap up. But we've been talking about households, and I'm guessing maybe one thing that a lot of people who are watching might be thinking about is about their own retirement portfolios and their own investment strategies. And so what would you say as somebody who studies corporate finance about what should people be doing personally with their own portfolio?
Well, yeah, I mean, my advice to people is always that don't do much to your portfolio. There's never a good time to buy or sell stocks, because nobody really knows what we really cannot predict the stock market, right? So the stock market is fundamentally unpredictable, and it's not a good idea to manage your portfolio by thinking about, our stocks are going to go up or stocks are going to go down, or betting that there's going to be a financial crisis. If you are a hedge fund manager like Bill Ackman, that's your job, right? But if you're managing your retirement portfolio, my recommendation is don't change anything. I mean, if you have, the important thing with the retirement plan is to have a long-term plan, right? And if you don't have that long-term plan in place, now it's it's like we like to say, right? The best time to do this was 20 years ago, but the second best time is now, right? So planning is crucial, and if you have a plan in place, you don't really have to worry about the stock. So, for example, one of the financial advice that we give to people is, once you're approaching retirement, you have to move out of the stock market, right? It's not 100%, but you have to move part of your portfolio to bonds and to safer securities to hedge against the possibility that you're going to have a crisis, right? And stocks are going to go down by 20-30%, and then you're going to be worrying about your retirement. So I mean, but if people manage this with a long-term plan, you're less likely to end up in this situation. So my recommendation is, don't do anything. We have evidence in finance suggesting that people are very bad traders. So people tend to trade in the wrong direction at the wrong time, and they lose a lot of money that ends up in the pocket of the hedge funds, right? We're on the other side of the transaction. So I recommend don't doing anything. So.
All right. Well, I think, with that, I think we'll pass it back to Jean.
Great. All right. Well, thank you very much, both Heitor and Bob, for exploring these complex issues and giving your insights. And the scope was really staggering, from the national level all the way down to the individual household. These are complex issues. We know there's a lot of pain out there, and we appreciate the sensitivity with which you have approached this topic. A list of topics on tonight's session will be posted to the website course schedule page under this week's topic. We hope that you've all had a good Thanksgiving weekend. When you're seeing this, it'll be Thanksgiving weekend. And our next session on December 6th is on COVID-19 and the Champaign-Urbana community, with Ms. Julie Pride from the Champaign-Urbana Public Health District and Mr. Tracy Dace from DREAM, which stands for Driven to Reach Excellence and Academic Achievement for Males, the project known as DREAM. So we hope you enjoyed and learned from tonight's session, and we wish you all the best to stay safe and stay healthy, and we'll see you again next week. Thanks again, Heitor and Bob. Bye-bye.
Thank you. Bye.